This is the second video of a series on leveraged buyouts, LBOs. In today's video, we're going to be discussing characteristics of a good LBO candidate. So the first and probably the most important characteristic is the cash flow generation ability. Because if you remember, the LBO is about acquiring a company with a relatively small percentage of equity and a high amount of debt, and then eventually paying down this debt. And it's only possible if this target company is producing strong, stable, and predictable cash flows. Well, a good way to measure this is by looking at the cash conversion ratio. So this is the free cash flow to the firm divided by EBITDA. And if this is higher, then it's better because it means that you're converting more of your EBITDA into free cash flow. Now the second measure, and keep in mind that these are somewhat in decreasing importance, but it's not a strictly defined decreasing importance. So probably cash flow is the most important, but it doesn't mean that the others are strictly less important. The second characteristic would be the management team. It's really important to have a competent and experienced team that's willing to cooperate with the new PE owners, because you can't really execute a LBO if you don't have a really strong team. The third would be operational improvements. So you're looking at companies where it's possible to improve their margins, to reduce the working capital, because this is just going to boost your IRR if you're able to improve the EBITDA margins, for instance. The fourth would be growth opportunities. So here you'd want to look at companies that are where you see the potential for further organic growth or consolidation opportunities. So if you're looking at a particularly fragmented industry, you could do a so-called buy and build play, where you acquire a platform business and then add on other acquisitions onto it to eventually sort of grow one company and to consolidate that particular market. The next characteristics that are quite good and quite important would be that the company has low investment requirements, so that it's a mature business that requires little capex and little working capital to run the business, because it obviously means if there's little capex needed, then you'll be able to spend more of the free cash flows on paying down the debt. Next, it's really important that you've got an exit in your sight, because if it's impossible to exit the company after 3 to 5 years, if you can't imagine sort of an opportunity we'd be able to sell this company, so maybe if it's, let's say, in a really specialized industry where there's just not a logical buyer or maybe not a logical IPO, then it's going to be quite difficult to do an LBO of this, because you'll be able to acquire the business but you won't be able to sell it on. Next, it's really important that your purchase price isn't too high. So obviously what's too high, what's too low is you can't define this objectively, but if you're paying a sort of really high premium on the company when you're acquiring it, then it creates a sort of double effect which reduces your returns. And the first effect is that you're obviously going to need a higher or your entry equity is going to be relatively higher, and that is also the risk that you're going to be selling your company at a lower multiple than you bought it for, if the purchase price was sort of inflated or you just paid too much. And lastly, it's quite important that the company has a strong asset base, because if your company's got machines or equipment, you'll be able to use that as collateral to raise the debt against. So it's very difficult to do an LBO if the company's just got zero assets. I think it's virtually impossible. So these were characteristics that are really important. Let me know if you've got any comments or suggestions, and make sure to subscribe. Thank you so much for watching.